I should figure not, but I just like them when I see them.
In terms of the potential for a credit crunch coming through what the banks are going through right now, there's been a lot of speculation about what that could mean to the economy. Is it going to mean a 0.5% hit to GDP? Is it going to mean a 1% hit to GDP? What would you guess?
I would say that I've been in business running Berkshire for 58 years, and I've never.
While banks in the financial sector have learned to cope with a variety of challenges, there is one risk that they cannot ignore, which is the risk of losing their capital. Famous investor Warren Buffett warned of a massive $2.2 trillion underperformance that is set to have a major impact on the banking industry. This cautionary note highlights the complexity of the situation, tracing its roots back to over 4 decades ago, bringing us to the realization that each passing day brings us closer to the expected fall. In a dynamic business environment, interest rate fluctuations present a formidable challenge, which means failure to manage these challenges can result in significant financial losses. In a recent interview, Warren Buffett shared valuable insights into the banking industry, focusing particularly on commercial real estate. When asked about the concerns raised by some investors regarding a possible crisis, Buffett emphasized the strength of banks in handling losses. He explained that while shareholders might face losses, depositors would remain protected, calling attention to a fundamental principle in banking that depositors' security is paramount. Buffett stressed the certainty of occasional losses in banking, but shows the importance of huge capital reserves to weather economic challenges. Discussing these 3-letter words, commercial real estate, he pointed out the risks associated with lenders who extend themselves too far. Using recent examples such as Blackstone's actions in Los Angeles, Buffett highlighted the potential consequences of non-recourse mortgages, where borrowers can walk away, leaving banks to manage the fallout. Despite these challenges, Buffett expressed confidence in the banking sector's resilience, emphasizing the need for wise risk management and regulatory measures like the FDIC to safeguard depositors' funds. Understanding the banking business model. To grasp Buffett's insights fully, it's crucial to comprehend the fundamental workings of a bank. At its core, banking revolves around the simple concept of lending money. Banks possess funds that they then lend out to individuals and businesses in need. These borrowers repay the borrowed sum over time, along with interest, ultimately resulting in a win-win scenario. Borrowers acquire assets or investments they couldn't afford upfront, while banks profit from the interest accrued on the loan. While this lending process may seem straightforward, there's more to the story. Understanding Buffett's concerns requires going deep into how banks acquire the funds they lend. Saying this right now, I know many won't believe it, but banks don't typically loan out their own capital. Instead, they leverage customer deposits, a lesser-known aspect of the banking model that introduces significant risk. To illustrate this, consider a loan between friends, where the lender relies on borrowed funds to extend credit. This hidden facet of banking shows the potential fragility of the system and the importance of wise financial management. In this example, we are introduced to John and Michael, where Michael joyful about a date with his dream girl, but then he is facing a financial hurdle, with the date coming on a Saturday night and payday won't be available till Monday. Then Michael turns to his friend John for help. Michael proposes borrowing $100 from John, promising to repay $120 on Monday, $20 more than the original sum, as a gesture of gratitude for the timely assistance. Despite John's willingness to assist, he encounters a predicament, which is, he lacks the full $100 requested by Michael. He only has $20 with him. John devises a plan involving his acquaintance Tim, who's known for his financial wisdom. John persuades Tim to lend him $80, assuring payment of the principal plus 10% in interest by Monday. With Tim's assistance, John now has the $100 needed to fulfill Michael's request. Fortunately, the plan went smoothly, coming to an end with Michael's successful date and timely repayment to John. With the borrowed funds repaid, along with the agreed-upon interest, John reflects on the outcome, realizing the financial opportunity he seized by leveraging both his own resources and borrowed capital from Tim. The essence of how banks operate is similar to the lending example shown in our earlier story. In reality, banks primarily lend out funds that belong to their customers, sourced from deposits made in various accounts. Subsequently, banks leverage these deposits by loaning them out to borrowers, aiming to profit from the interest spread between what they pay depositors and what they charge borrowers. This intermediary role represents John's actions in our narrative, where he orchestrates lending transactions between Michael and Tim. While this banking model holds immense potential for profitability, John gained from it by adding $10 to the initial $20 that was with him, which now made him to have $30 in total, and Tim also has his own gain of $10 from the transaction. The banking model can also result in something disastrous considering this example. In a less favorable scenario, mirroring the challenges encountered by John, Michael, and Tim, a fall of adverse events can happen. Imagine Michael's date ending disastrously, making him sad and unable to go to work on Monday for him to get his paycheck, then leaving him unable to repay his debt to John as planned. This failure to honor the loan repayment rings through the lending chain, leaving John stranded with borrowed funds from Tim and facing mounting pressure to settle his debts. Such situations, though fictional in our story, represent the potential pitfalls banks confront when borrowers default on loans, jeopardizing their financial health and stability. The parallels between our anecdote and the broader banking landscape shows the significance of wisdom and risk management going through financial systems. With potentially trillions of dollars at stake in the banking sector, the repercussions of loan defaults and financial distress are far-reaching, emphasizing the imperative for strong safeguards and vigilant oversight to mitigate systemic risks. The risks of interest rate resets. The focal point of the coming crisis in the banking industry lies within the realm of commercial real estate. Before delving into the potential ramifications of this impending dilemma, it's crucial to understand the origins of the problem. The direction leading to this critical juncture traces back to a significant macroeconomic phenomenon is the pattern of interest rates over the past 4 decades. A pivotal indicator of this trajectory is the U.S. Fed funds rate, serving as a barometer for broader interest rate trends. Witnessing a peak of nearly 20% in the early 1980s, this rate steadily declined over subsequent years, eventually bottoming out near 0% in December 2008. This prolonged period of declining interest rates exerted a profound influence on asset valuations, particularly in the real estate sector, where debt serves as the cornerstone of transactions. The real estate market emerged as a primary beneficiary of the declining interest rate environment, fueled by the accessibility of cheap debt. With borrowing costs diminishing, individuals and businesses capitalized on the opportunity to expand their real estate holdings, leveraging debt to finance acquisitions. This surge in demand propelled property prices to unprecedented heights, underpinned by the prevailing low-rate environment and a sustained upward trajectory in property values spanning over 4 decades. However, this era of prosperity is now facing a formidable challenge, precipitating a seismic shift with far-reaching implications for the stability of the banking sector. Banking sector vulnerabilities. In the United States, residential property purchases often rely on a 30-year fixed-rate mortgage, offering stability through a consistent interest rate over the loan's lifespan. This structure provides buyers with security, mitigating the risk of unforeseen spikes in monthly payments due to interest rate fluctuations. However, the example is markedly different for commercial property acquisitions. Commercial loans typically operate on shorter terms, ranging from 3 to 5 years, with variable interest rates subject to adjustment based on prevailing market conditions. Although seemingly innocuous, the impact of these interest rate resets on commercial property owners can be great. The economic landscape between 2009 and the first quarter of 2022 witnessed historically low interest rates, prompting a flow in real estate investment fueled by abundant and cheap debt. However, a paradigm shift has been since revealed, as efforts to curb inflation led to a rapid and substantial increase in interest rates by the U.S. Federal Reserve. This rapid increase has propelled interest rates to their highest levels in 2 decades, setting the stage for a potential crisis within the banking sector. At the heart of this coming crisis lies the $2.2 trillion worth of commercial loans held by banks, originated during the era of lower interest rates. As these loans approach maturity, the prospect of resetting interest rates comes large, presenting significant challenges for both lenders and borrowers. The ramifications extend far beyond individual financial institutions and property owners, casting a shadow of uncertainty over the broader economy. Consider an example where the owner of a small apartment building earns $100,000 annually after covering all expenses. Let's assume this owner holds a $2 million loan on the property, structured as an interest-only loan. At a 3% interest rate, the owner's annual interest payment amounts to $60,000, a manageable expense covered by the property's income. However, as we raise the interest rate, the financial strain on the owner becomes evident. At a 4% interest rate, The annual payment escalates to $80,000, still within the property's income capacity by presenting tighter margins. When the interest rate climbs to 6%, the annual payment soars to $120,000, surpassing the property's annual income. In such a scenario, the owner faces a precarious situation where the property's revenue falls short of covering the loan interest, potentially leading to foreclosure if the shortfall persists. Banking sector vulnerabilities. This predicament shows the vulnerability of banks, as even modest losses can jeopardize their stability. Consider a bank with $100 million in outstanding loans, financed primarily through customer deposits. While regulations mandate the maintenance of a capital reserve, a significant downturn in loan performance can deplete this buffer rapidly, leaving the bank exposed to financial instability and customer withdrawal pressures. In banking, having $10 million seems like a lot to fall back on, but banking can get tricky fast. Let's say 20% of a bank's loans go bad, totaling $20 million. Even if the bank sells off properties and gets back 70% of what's owed, that's just $14 million recovered. So the bank ends up losing $6 million, the gap between the original $20 million loan and what they got back. That $6 million comes out of the $10 million reserve, leaving only $4 million to handle any more trouble. As news spread about the significant loss incurred by the bank, customers begin to feel uneasy and rush to withdraw their money. This sudden surge of withdrawals creates chaos within the bank as customers demand to access their funds. The situation quickly escalates, setting the stage for potential disaster. However, the bank doesn't have most of the deposited funds readily available in its vaults. The majority of these deposits have already been utilized to provide loans to various borrowers. This practice, known as lend long and borrow short, exposes banks to substantial risk. While they lend money over extended periods, they rely on short-term customer deposits for liquidity. As customer demands for withdrawals intensify, the bank must comply, depleting its capital reserves. With each withdrawal, the bank's capital reserve diminishes rapidly, eventually reaching zero. At this point, the bank becomes insolvent and is forced to cease operations. Despite this grim scenario, the United States provides deposit insurance, guaranteeing up to $250,000 per bank account in the event of a collapse. However, the repercussions of such a collapse can still reverberate throughout the economy. As illustrated by data, a significant portion of real estate loans is held by smaller banks, emphasizing the potential impact on local community banks essential for economic development. When banks face losses on loans, it hampers their capacity to extend credit in the future, assuming they can weather the loss without collapsing. This reduced lending ability has far-reaching consequences across the economy. Consider a beloved local restaurant in your town. With its popularity soaring and lines consistently out the door, the owner decides it's time to expand. However, expansion requires substantial funding, likely sought from a small community bank or a credit union. If the loan is approved, a multitude of individuals and businesses stand to benefit. Contractors will be hired for renovations, along with plumbers, electricians, painters, and handymen, boosting their income. Additionally, real estate brokers, lawyers, and accountants will see increased business. This expansion promises a significant economic boost. But what if the bank rejects the loan? Despite its willingness, the bank lacks the capacity due to recent loan losses. Consequently, all those poised to benefit from the restaurant expansion are left in the lurch. While hypothetical, similar real-life scenarios unfold across the United States, underscoring how banking troubles can ripple through the broader economy. The outcome remains uncertain. Warren Buffett predicts some banks may face complete collapse. The looming question is the extent of the fallout and how far-reaching it will be. Conclusion. There you have it. This is the end of our discussion on this video today. Remember, it's crucial to recognize that every decision made within the banking sector has far-reaching effects, touching everything from local businesses to personal finances. So let's stay informed and remain vigilant, working together to forge a stronger and more stable financial future. If you found this video helpful, don't forget to like, share, and subscribe to this channel for more engaging content. Thank you for watching, and see you in the next video.